Hi, I'm Malessa Rambarran.
And I'm Candice Milano.
Welcome back to The Build-Up, presented by Brown Harris Stevens and Guaranteed Rate, where we discuss the secrets of building wealth through real estate.
Today we're joined by Brian Burke, the president and CEO of Praxis Capital, a private equity real estate firm with more than $500 million in assets under management. Brian started just as a hands-on investor, buying, flipping, and managing single-family homes until he scaled his business into a national portfolio of multifamily properties and a syndicated fund. He's also the author of The Hands-Off Investor, one of the best guides for anyone looking to invest passively in real estate.
Okay, so let's talk office. Did you see that headline that SL Green just bought Park Avenue Tower for $730 million? You know, this is a big move, especially here in New York City, where we've had many conversations about office and the comeback and returning to work and all of that. And, you know, this is a really good indication. A lot of people are saying that this might just be the comeback of the office market.
Yes, it's a bold move for sure. SL Green is not just any player. They're the Manhattan's largest commercial landlord. And so while many investors are running for the exits, this is a major entry into the commercial market for them.
You know, that's a very interesting point, because that conversation with Brian today, he said something very insightful where he said, you know, if everyone's running from something, that's when you kind of look at it, right? And this is really giving me that vibe of, you know, SL Green looking at the office market when everyone else is shying away from it.
Exactly. So if SL Green can structure financing successfully, this will send a ripple effect, because it really serves as now the new comp. There's new confidence in the market, again, by a major player in the industry. And so this might really open up liquidity for a lot of owners that have really suffered over the past few years during this downturn.
Mm-hmm. Right, and it's still not without risk. The Wall Street Journal noted that prime office values are down 45%. So if you're really going to get into the office space, you really have to have a lot of confidence in the long-term trajectory of New York City, but also, too, is the return to office. And look, like, we are here in New York City. We're here on Park Avenue. I have to tell you, it took me an hour where it should have been 40 minutes max to get to the office today. And I'm coming from downtown. So office is back. We can say that with a lot of confidence. It's been back here in Midtown. And I think a lot of people are seeing that now. And there's a renewed energy here in the city. And, you know, I, for one, when I'm here in Midtown, is just, you just want to get things done. You feel very inspired. And I think people are noticing that. And so I do believe, obviously, in New York City as a whole. So I think that's where, you know, SL Green is getting some confidence too. And hopefully it'll instill that confidence in the office market.
Yes, and that's why I feel that this move is more strategic than speculative. They're buying at the bottom of the market, which of course there's no better time. They're repositioning the building, and they're really betting on hybrid work schedules. Leasing data is starting to show more tenant renewals, not crazy absorption, but it's definitely been steady.
You know, if SL Green is leading this new wave of office confidence, you know, we're going to see a lot of pressure on the city to change some policies in terms of tax advantages and zoning relief, both for commercial conversions and renovations.
Right, because the office market doesn't exist in isolation. It affects everything from retail to obviously property tax revenue. So a move like this could really be the first domino to fall in what we're considering to be a slow burn recovery.
Of course. Look, like, we're here, like I said, in the city, so we're very invested in seeing where this goes. So we'll be following it and reporting on it soon.
Yeah, so either SL Green is visionaries or long-term investors, but a lot of times in New York City real estate market, they end up being the same.
I'm Brian Scott Cohen, one of the top loan originators in the country, and the #1 mortgage originator at Guaranteed Rate Infinity. Guaranteed Rate Infinity arguably has the most advanced tech in the industry. Our completely digital loan process makes it easy and efficient for homeowners, from a 15-minute pre-approval to the digital application and through closing. My team and I would love to help you get into the home of your dreams.
From residential and commercial closings to litigation, Romer DeBoss is your full-service real estate law firm. We blend big firm knowledge with boutique-level attention, delivering outcomes that exceed every expectation. Contact us at romerdeboss.com.
If you've ever wondered how investors go from managing one property to leading multi-million-dollar portfolios, you're going to love this conversation. Brian Burke joins us to unpack the systems, mindset, and strategies behind building wealth through real estate syndications. Brian, welcome to the Build Up.
Thanks for having me here.
Of course, we're very excited to have this conversation with you today. A lot of insights from you. But let's start from the beginning, because every investor's journey has a moment that sets everything in motion. And you've been in real estate for over 30 years. So what first pulled you into the world of investing in real estate?
Well, I think an act of desperation. I didn't have any other particular skill set to offer the world. So I figured, you know what? I read a book that said that you could invest in real estate with no money down, and I have no money, so I might as well try investing in real estate. And I gave it a shot. I had no money, no contacts, no knowledge, no connections in the industry. So I figured I was fully equipped for a real estate career, and I might as well give it a go, because what else am I going to do?
We usually hear that from the broker's side, right? They're usually desperate for money. So they are like, okay, let's get into real estate. It's going to be quick money, but not from an investor's point of view. So that's quite interesting.
Yeah, it's great to hear that you're able to get in too without, having this network and having a lot of money in the bank, because often our listeners and even, ourselves came from similar positions. So you mentioned that it came out of this kind of, lack of another opportunity. But how did you get started? What was the first type of investing that you delved into?
Well, after I finished reading the book that said I could buy a house with no money down, I gave that a shot. I found this house that I could buy to rent out. And I asked the seller if they would carry back the down payment, and lo and behold, they said yes. So I bought my first rental house with no money down, and that was all I could have possibly done at the time. And I rented that out, fixed it up, sold it, and made nothing, and thought, well, this is addictive. Let's do this again, because I must be a glutton for punishment. So then I got into house flipping, and that was kind of the next phase of my career. And it was really a way to generate income. When you're young and trying to make a go of it in real estate and need a quick buck, house flipping was kind of the one thing that drew me. So I originally started out, flipping a house here and there. I did a couple of them over the course of 2 or 3 years, and then finally figured out the recipe and became a serial house flipper, and was doing a couple dozen houses a year, which after the economic collapse of 2009 turned into 100 houses a year. And, after doing about 400 or 500 flips, I figured it was time to start expanding my horizons and doing multifamily. So 20 years ago, I got into multifamily through a 1031 exchange, and kind of the rest is history. From that point forward, I figured out that multifamily and larger scale was a skill set that I found I was particularly good at. Stuck with it, and over the last 36 years, I've bought about 750 houses, about 4,000 apartment units. I've done hotels, self-storage, vacant land, residential subdivisions, built new houses. Kind of gone all the way around all four corners of real estate investing, so to speak. And really have landed on income producing property as kind of my core competency. And that's really what I'm sticking to.
Yeah, you've really seen it all. And that's one of the things that's so great about real estate investing, is that there's so many niches. So whatever someone finds really speaks to them, or finds, competency in, they can really focus on. But it's definitely not one size fits all. And a lot of investing comes to your mindset. So what do you feel was that shift in your mindset when you were transitioning from, your flipping business into larger scale multifamily assets?
Just realizing that, single family house flipping and even single family ownership in general isn't particularly scalable. I mean, certainly you can collect a really nice portfolio, and it doesn't take much of a portfolio to end up leading a life better than 99% of the population when you retire if you just collect a small portfolio of rental homes. It doesn't have to be complicated. But if you want to scale, scaling a portfolio of single families is tough. At one point I had 120, 125, maybe 130 rental houses. And that's a lot, it's a lot, but it's a little, because then later on we had 4,000 multifamily units, and that was easier to manage than 120 rental houses. So I just, with a goal to scale, multifamily was really the way for me to do that. And realizing that I wasn't going to be able to replicate that kind of result in any other asset class particularly. And I think that's what drew me to that specific core competency.
And you eventually also moved into syndications, right? And then you started raising capital. And of course, like you mentioned, managing large multifamily portfolios. So obviously, that's a big step up from doing things on your own, like you mentioned initially. So what was the turning point that pushed you to scale through syndications?
Yeah, well, a lot of people think that it's a binary thing, right? Where you're either investing on your own or you're syndicating and you're syndicating large deals, but it doesn't have to be that way. I think that a natural progression of growth is a great way for an investor to kind of expand their career and expand their horizons. And that's exactly how I did it. When I was trying to grow my house flipping business, I realized that I wasn't going to be able to do it with just the capital I had on my own. So I actually created a small syndication fund, and it was literally my coworkers. I was working at the time in law enforcement, and the flipping was the job was getting in the way of the flipping, and it's like, okay, I've got to quit my job or I'm not going to be able to keep this going. But if I want to expand, I'm going to need more capital. So I told all the guys at the police department, I'm like, hey, I just quit. I just put in my 2 weeks notice. I rented out the room at the community center. If you guys will come, I'll tell you everything I'm doing in real estate and why I'm doing it. So everybody came, and I gave this whole talk about real estate investing, median home prices, house flipping, investing, and all that stuff. And I said, look, if you guys will invest with me, I'll take investments as small as $5,000 and I'll split the profits with you 50-50. And I swear if I didn't walk out of that room with $500,000 of investment commitments, and I used that money to grow my house flipping business. And then as I did that, then those investors were telling their friends like, oh, hey, I invested with this guy I used to work with and he's doing this and that. So then they would call me like, do you have anything for me to invest in? And so it kind of just grew organically over time. And it's like each time I would raise capital for a new thing, it was bigger than the last time. And I had more investors than I did the previous time. So, my first fund, I started out with 28 investors. Now I've got over 2,800 investors. And I never advertised, I didn't have any billboards on the freeway or anything like that. It was all just about people telling people about their experience and other people wanting to be a part of it. And in order to deploy capital at that kind of a scale, you have to have real estate at that kind of a scale. And that's what kind of, I grew into multifamily as I was growing the capital raising side alongside of that. And I think really that's the best way to grow a syndication business rather than saying like, hey, I've never bought a single piece of real estate in my life. I'm going to go buy this 200-unit apartment complex. Will you guys invest $10 million with me? It's probably unlikely that you're going to succeed using that kind of a method. Much better to ease your way in, grow your investor base organically, and you can have massive growth beyond anything you ever imagined.
Wow, I love that story because it shows again like how you can grow from something small into, something more substantial. And that's what, real estate is always the long-term gain. So often people that come in for that quick return often find out it's not the right path and, or asset class, as you said. But on top of everything else you've done, you've also written a book called The Hands-Off Investor to really help passive investors. So in your education and through the book, what's one key red flag that people should watch for when they're vetting a deal or a sponsor with syndications?
Yeah, if you're investing passively in syndications, you're putting up a substantial amount of your hard-earned cash that probably didn't come to you very easily. So you need to take care of it, and not get too casual about making that placement of capital. So I always advocate that when you're looking for an investment like this, the sponsor you're investing with is the most critical component that you're going to have to evaluate. You can get into great deals, you can get into bad deals, but it doesn't matter if the deal is good or bad. If the sponsor is bad, it's bad. Even the best real estate deal with a bad sponsor is a disaster. So it's really important that you invest with somebody that knows what they're doing. And I say that there's basically 3 trust circles that you need to complete in order to make an investment. And I also tell new syndicators the opposite story, the same story from the other side of the table. So let's tell it from the passive investor side of the table. The 3 trust circles are: first, you have to trust the asset class that you're investing in. If somebody's presenting you with a multifamily investment opportunity and you think, well, multifamily is not really in season right now, it's not a good place to place capital. I don't care how good of a sponsor they are. I don't care how good the deal is. That investment's just not for you. You just flat out don't believe in it, and you need to believe in it. The second is you have to trust the sponsor. And this is probably the most important piece. If you don't trust that the sponsor is the right group to carry out this business plan, then you should move on, pass, and look for a group that is. And third, you have to trust the deal. And it's not just a matter of, is it at the corner of Main and Main? It's all about the structure of the deal, the incentives, how the fees and profit splits and stuff are constructed so that it properly incentivizes the investment sponsor to produce results for you. It's the financial underwriting and modeling, all of those things. And I think one thing I tried to convey through the book is to show passive investors how to evaluate each of those things. How do you evaluate a sector of real estate? How do you evaluate a sponsor and their competency and their ability and their experience and track record? And finally, how do you evaluate a deal and a deal structure to determine if it's suitable for you? Because this is a long-term marriage. It's not like, oh, I'm going to buy this house, fix it up, flip it, and be out of it in 4 months, and then I can move on. This is, you're making a 6-figure capital investment with somebody that maybe you don't know very well on what could be a 3, 5, 7, or even 10-year deal. And you've got to trust that they're going to take good care of your capital because there's no way out. It's not like a stock you can hit the sell button. You're in it for the long haul. So make sure that you make the right decision up front by taking the time to really evaluate that in advance.
That's really, very insightful. And especially you have this book that really outlines that. I think a lot of new investors who are not really savvy with real estate, they often get very overwhelmed with the process. So it really stops them from making, a really good investment. So that's really great that you were able to outline that. But of course, no strategy is without its challenges. And you've been through multiple market cycles, boom, crashes, now recent interest rate hikes. So let's talk about some risks, right? How do you stress test your deals for downturns and sudden market changes?
Yeah, stress testing is extraordinarily important, I think, on both sides. It's important for passive investors to look for sponsors that are stress testing their deals, because sponsors that don't stress test the deals get themselves into a lot of trouble. So you got to look. I think probably the most important thing people need to look for is what's the maturity term of the loan? How long of a runway do you have? And if you're getting into a deal where the loan matures in 2 or 3 years, that's simply just not enough time for the whole thing to play out. And, the market could go down and then you could be stuck having to sell in a down market. And I think that's what we're seeing a lot of right now from a lot of syndications that got started in 2021, 2022. They had 3-year loans, and now the 3 years is up and the market's in a down cycle and they have no way out. So one of the big stress tests that I think is the most important is, how long of a runway do you have? How long can you wait for a market recovery before somebody else forces your hand to have to make a decision? That, to me, is the biggest piece of stress test there.
Yes, that's very, very important, and something that a lot of investors overlook because they get excited about the deal and, the projections and everything, but really good to call that out. How about for yourself, though? Can you share a moment where things didn't go as planned and what that experience taught you about managing risk?
Yeah, I had a deal that I did back in 2009, and it was, during the GFC, right? The Great Financial Collapse. And I bought this 60-unit apartment building for half the price that the previous owner before me had paid. And I thought, well, this is brilliant, right? This is what the book says to do, right? You buy real estate at a discount and you'll be fine. Well, right after I did that, I bought it. I started fixing it up. I got the occupancy from like 70% to 99%, and it lasted for about a week. And then the next thing you know, the economy is tanking, Lehman Brothers collapses, Bear Stearns collapses. There's like all kinds of calamity in the markets, and real estate was going down even further. And I realized then the power of economic down cycles and also leverage. This was a deal where the previous owner was in foreclosure. The lender said, we got the property in receivership. We'll finance 100% of the purchase price for you. And I'm like, great, no money down, love it. So then you realize, once you're into it, now you're like, okay, the economy is bad. Half the units are empty and the other half aren't paying. And I've got, this 100% of value loan with all this debt service. And this is a really tough place to be. So it's like, you got to kind of understand how powerful it is when the economy moves against you and make sure that you've got defenses in place And I learned a big lesson from that is, don't be try to get in too early into a market cycle. You can wait for it to play out a little bit. And second, don't over leverage and have too much debt. It's okay to come in with low leverage and have a little bit of extra margins of safety.
Yeah, clearly, you've adapted and stay ahead of the curve. You're doing very well. And you have a lot of insight that you've shared here also on the show. But what's really exciting you about the real estate market right now? What are you most looking forward to?
Well, I've been doing this so long that nothing excites me anymore. I try not to get too emotional about the market. It's just take a very pragmatic approach. But I'll say that I'm seeing a setup for, potentially some interesting times on the multifamily side because prices are down a lot. And it's too early right now, at least in the context of large multifamily syndication. It's too early to be a buyer and a syndicator for that right now, in my opinion. I mean, it's a great time if you're an individual investor trying to build a retirement portfolio and you want to buy some, smaller multi-unit deals. There's some great opportunities out there. But I think, for someone like me, that strategy just isn't really playing out right now. But I think it will in a couple of years. There's going to be some really interesting opportunities in a couple of years, much better than we would have seen had this kind of dislocation in the market not occurred. The other thing that we're doing right now is we just launched a fund a few months ago. We're acquiring skilled nursing, assisted living, and memory care, so senior housing healthcare properties. And that segment of commercial real estate is just absolutely on a tear. I mean, it's coming out of a bottoming in the cycle. It's, values are at a 10-year low. Construction is at an almost non-existent. Demand is going through the roof. The senior population is expected to go skyrocket here over the next decade. So that's a perfect setup for a really good opportunity. And so I'm really excited that we have the opportunity to bring that to our investors, in this climate.
Yeah, it's awesome that you're finding a new opportunity amidst, overall where the market sometimes feels down right now with high interest rates and everything like that. But are you focusing on that across the whole country? Are you focusing on certain markets? Like, where are you seeing those opportunities?
Yeah, this is something that's kind of market agnostic. In multifamily, we want to be buying where the population is going, right? We want to buy where people are moving to, not where people are moving from, because it's the movement of demographics that drives income in that sector. This is a different story, in the senior housing healthcare. I don't need people to move to the area. I just need them to stay put and get older. So, we're buying literally all over the country right now. Most of our stuff is kind of in the Midwest and Southeast, but we're looking all over the place, coast to coast, and there's opportunities everywhere.
Great. And so for our listeners who, perhaps they have, a small portfolio and they're now thinking of, hey, I'm inspired by this conversation. I want to grow bigger and I want to invest passively. What would be a takeaway that you would offer to them?
Yeah, if you're looking to just get into passive investing, I would say be selective about who you invest with. Take your time to find the right sponsors. Don't be in any kind of a rush because nothing is really going anywhere right now. It's like values aren't skyrocketing to the point where you go like, well, if I don't do something this year, it's going to cost me 20% more next year. Not the case. There's time and runway here for you to just take it slow. I think that's a good piece of advice. Invest with top quality sponsors and look for cash flow. There's all kinds of promises of appreciation out there, but nothing beats getting a check every quarter. So, if you can find cash flow, you're putting some money in the bank. And I think that's something that a lot of investors are placing emphasis on.
We couldn't agree more. And to finish off this really great conversation, one of the things you've highlighted today for us is your experience going through many market cycles. And I think that's so valuable. So, in closing, can you share really what is one mindset or principle that's really guided you through both the highs and lows of your career?
Yeah, the thing I learned about market cycles is it's a lot about psychology. People want to attach it to variety of different quantifiable, KPIs, right? Like, oh, if, GDP is this, or if interest rates are that, or, some kind of a numerical value. There's a better way to approach market cycles, and it's about the psychological capital that's in play in the market. So when in 2020 and 2021, everybody was buying multifamily. And it was like, this was the time. Buy, 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 buy. So what did I do? Sell. I sold 3/4 of my multifamily portfolio in 2020 and 2021, right before the market collapsed, because when everybody wants to buy, it's a great time to be a seller. When everybody wants to be a seller or nobody else wants to buy, it's a great time to be a buyer. So think about the psychology of what's happening out there in the market and use that as a barometer for what you should do. And usually what that means is you want to do the opposite of what everybody else is doing, because that's how you're going to be the most successful. And that's my approach to market cycles. And it's worked for me for about 3 decades.
I love that. That's really profound. And we're really glad that we can leave off on that really valuable piece of advice that hopefully we can all follow. So thank you, Brian, so much for joining us today. Thank you for sharing your wisdom over decades of acquiring it on how to really invest smarter, manage risk, and scale.
Thanks for having me here.
Thank you.
What do you really need to know about buying or selling a home? First, it's serious business, and it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.
And that's a wrap on today's episode of The Build Up. If you found value in this conversation with Brian Burke, subscribe, share, and join us next time as we continue breaking down the path to building wealth, one conversation at a time.
This podcast is for informational purposes only and does not constitute tax, legal, or investment advice.
For specific recommendations, please consult with your financial, legal, or tax professional.
Your phone or always leaves your text on red? Leaves your text on red.
Built the corporate group with $1,000 loan.
Tell us a little bit about how you actually came from.
Welcome to The Build Up, John Roa.
Thanks for having me. We're coming to you here from Studio 1873.
Just about 57% over. $27 million.
So then, cheers.